So first of all, we have stocks, and this is the one that most people are familiar with. By now, from the beginning of this course, you understand what stocks are. It's a piece of ownership of a company. When you look at stocks, they can be broken down into a few different categories. So first of all, we have blue chip stocks, and then we have growth stocks, and then we have what I call the speculative or penny stocks. And this isn't something I coined myself. This is what people call these. They call them speculations, speculative bets, or penny stocks. Now, each stock category has unique characteristics and a different risk and reward potential. And you should understand what category a stock falls into before investing in it. So, if you can't tell me, if you're looking at a company and you have no idea if it's a penny stock, if it's a growth stock, or a blue chip stock, then you need to know more about that stock and that company before you invest. So you should understand what category your stock falls into. And really there are even more categories that you could break these down into, but these are the main ones that I tend to focus on, because most stocks you're looking out there are going to fall into one of these three categories based on market capitalization mostly, as well as some other factors we're going to talk about. So first of all, we have blue chip stocks, and these are the stocks I recommend to most beginners and honestly most long-term investors out there. These are the only companies that I really would recommend investing in long-term, are these blue chip stocks. So blue chip stocks are the stocks of well-established, financially stable, and well-managed companies. So these are companies with decades, if not centuries, of records. So these are not companies that just formed overnight. This is not your Snapchat. This is not even Google. This is not even Facebook. This is companies like Pfizer. This is companies like Procter & Gamble that have been around for hundreds of years. This is like General Mills. Some of these old companies that are really old school businesses that have been around for decades, and they really have shown just decades of consistency. And as a result, investors see them as very safe investments, and historically speaking, they are more durable investments. Now, blue chip companies are the leaders of the industry they serve, or they are at least in the top three. Due to the fact that many investors see them as a safer investment, the blue chip stocks are less volatile than growth stocks. And one of the main reasons is because when people invest in these blue chip stocks, they are typically doing this on a long-term basis. So if somebody goes out there and they buy shares of Procter & Gamble or 3M or DuPont or some of these large companies, they're not going to be selling those shares anytime soon. You're not going to buy shares of 3M and then sell them a week later, because you're not going to see much of a change in that stock price at all. So when people invest in these blue chip stocks, they're investing for the long term. And a lot of the times, the people who invest in these blue chip stocks are seasoned investors. So when you do see a market correction, a lot of these people that invested in these blue chip stocks are seasoned investors, and they understand what corrections are, and as a result, they don't do this panicky selling that you're going to see happen with these growth stocks. When you invest in growth stocks and penny stocks, when you see a market correction, a lot of the people who invest in those are not invested in the companies long term. They're short term or mid term investors. So as soon as they see any kind of pullback, they are going to get out of those stocks, and as a result, you're going to see a much more drastic correction with those growth stocks. So that is one of the things I like about blue chip stocks, is they tend to be more durable investments. And the other thing is, many people flee to these stocks in times of uncertainty, especially things like utility stocks. And we're going to talk about what stocks hold up best during bear markets later on in this course. But many people do flee to these blue chip stocks in times of uncertainty solely because of their durability and their long-standing track record of success. Most blue chip stocks pay dividends to shareholders, which allows for compound interest, and if you're somebody who wants to take advantage of compound interest, this is one of the best ways you can do it, is through blue chip stocks that pay dividends. And if you aren't familiar with compound interest, I've done a bunch of videos about this on my channel, but we also have an entire module coming up dedicated solely to compound interest and investments you can find that will pay you compound interest, as well as why you guys should be interested in earning compound interest. So that's all coming up later on, but I highly recommend blue chip stocks for those of you who want to go out there and pick individual stock investments. A portfolio of blue chip stocks is a very powerful portfolio, and we're going to talk about later on how you even identify what a blue chip stock is. So like we already said, most investors who buy blue chip stocks are investing long term because they are seasoned investors and they know what they're doing. They understand that these are durable long term investments, and they're not going to be selling these investments in the short term, which makes these stocks a lot more durable and less volatile. So during a market correction, blue chip companies tend to be more durable, and a lot of people flee to these blue chips in times of uncertainty. So most long-term investors do not sell due to a short-term correction. I know I'm kind of repeating myself here. I forgot I had all these notes in here. So as far as finding a list of the blue chip stocks, there is no official set list of blue chip stocks out there. Most people look at things like their dividend history, their consistency of rising dividends, how long they have been meeting shareholder expectations. However, if you're looking for a good place to start, I would recommend the Dow Jones Industrial Average. And this is what many people consider to be the list of the 30 leading blue chip stocks or the blue chip companies. So that is probably a good place to start, is the Dow Jones Industrial Average. And later on, we're going to talk about index funds. And one of the most powerful index funds you could hold is an index fund tracking the Dow 30 or the Dow Jones Industrial Average if you want a broad portfolio of blue chip stocks. That's not a bad route to go either. So like we said, there's no set criteria for what is considered a blue chip stock. So if somebody were to go out there and say, oh, I see Microsoft and Apple is a blue chip stock, and I believe those are on the Dow 30, but somebody might argue that Google is a blue chip stock and Facebook is a blue chip solely based on market capitalization, while someone might say, no, I disagree with you. They don't have a long history. They haven't been around for decades. They're newer companies. So it all depends on what your own criteria is for what you consider to be a blue chip stock, and you could argue both sides depending on the company. So you're not going to find a set list of blue chip stocks out there, but the Dow Jones Industrial Average is really a great place to start. So why would somebody invest in blue chip stocks? Well, as we said, blue chip stocks pay dividends, so many blue chip investors are investing for income, and that is why blue chip stocks are often referred to as income stocks. These are people who want consistent profits and consistent income from their investments. The best comparison I can make of this is somebody who buys a rental property. So they invest in a rental property, and then each month they're renting that out and they are getting paid rental income while they are building equity. That's the best way I can describe a blue chip stock, is over time they should appreciate in value, and in the meantime they're paying you consistent cash payments in the form of dividends. So this is similar to a rental property, but then again, when you are comparing rental properties to stocks, what comes to mind is a REIT, or a real estate investment trust, which we're going to talk about later on in this section. So while blue chip stocks do not offer outstanding growth, they typically offer a steady cash payment through dividends, and this is something that is appealing to many investors, and I'm hoping it's something that interests you as well. The simple truth is, large companies do not grow as fast as small companies, and you basically have two options here. You can invest in growth stocks and try to take advantage of the growth of that company, or you can invest in larger companies and take advantage of their consistency and get those regular cash payments from dividends. So my favorite part about dividend stocks is that dividends allow you to be paid in two different ways, and we talked about this earlier on in this course, how you can use dividends to hedge against a loss, but you can be paid by the asset appreciation or the appreciation of the underlying stock, and also the regular cash dividend payments. In my opinion, blue chip stocks belong in any well-rounded investing portfolio, and this doesn't necessarily have to mean individual stock ownership. This could be ownership of an index that tracks blue chip stocks, so maybe this is the Dow 30. Specifically, they are great for conservative investors, young investors, and beginners who have low tolerance for risk. So really, I recommend blue chip stocks to just about anyone, especially those who want to hold individual stocks. What I recommend to most people, especially beginners, is if you don't want to worry about picking stocks and being an active investor, one of the best things you can do is own broad index funds, and we're going to talk about that later on. But if you want a more active role in your investing and you want to do things like study company reports and financial reports and read earnings reports, then I would recommend investing in blue chip stocks, because you certainly are going to learn the most by doing this. Now, blue chip stocks are great for investors looking for a passive investing approach, because like we said, these are a long-term investment. Typically, you're not going to buy blue chip stocks and be selling them anytime in the near future. So you're really going to invest in them and then set up a strategy for what you're going to do with those dividends. So if you can do this, I recommend setting up a DRIP, or a dividend reinvestment plan. And when you set this up, dividends are reinvested automatically back into the dividend issuing stock, and this is how you take advantage of compound interest. Now, not all brokers offer a DRIP, so this is something you want to look for when you are taking a look at what brokers have to offer. And the one thing I like about the DRIP is oftentimes, and I think I talk about this later on, but oftentimes a dividend reinvestment is commission free, so you don't even pay commission when you do that. But DRIPs are very powerful, and I highly recommend looking for a broker that offers a DRIP if you plan on going the route of investing in blue chip stocks. Now, here's the thing about blue chip stocks, and we kind of touched on this earlier, but blue chip stocks tend to be defensive investments. And what I mean by a defensive investment is that these are investments that are less affected or even unaffected by the underlying economic conditions. So here are some examples of defensive investments, and these are great investments in times of market uncertainty. And when I said many investors flee to these stocks in times of uncertainty or in a bear market, these are a lot of the industries that people flee to. So first of all, we have the utilities, we have household staples, we have food, we have beverage companies, we have medical treatments, and we have energy companies. And the reason being is that people are going to be buying these things no matter what. I mean, you're going to need electricity, you're going to need your medication, you're going to need to eat and drink, you're going to need to buy your household necessities, and you're going to need things like oil and natural gas, regardless of the underlying market conditions. Yeah, people are not going to be spending as much on clothing, they're not going to be spending as much on entertainment, but they're largely going to be spending the same amount of money on things like this because they need these no matter what. So defensive investments tend to hold up better in bear markets or a market correction. So for people that are looking for a lower risk and less volatile investment, I highly recommend blue chip stocks of these industries here, the utilities and the household staples. That is largely because time and time again, these have proven to be very durable investments. I mean, if you go back and look at some of the bear markets we have seen in the past, compare the S&P 500 correction to the correction of some of these large utility companies, and you will typically see that these held up a lot better during a market correction. So now we're going to talk about the Dow Jones Industrial Average, and we also have a whole section dedicated to stock market indexes. So this is going to be a little bit repetitive, but I just want to talk about this now because it ties in very well to this discussion on blue chip stocks. So the Dow Jones Industrial Average is a great place to start when it comes to looking for blue chip stocks. As we said, many people see this as the list of blue chip stocks. When investing in a dividend stock, it is important to consider the growth of the underlying investment as well as the dividend yield. So this is a mistake that many people make, is they are dazzled by dividends and they see a dividend yield and they see a high dividend and they think that is a great sign. So a company may have a lower dividend yield but see greater appreciation in share price. So many people make the mistake of solely looking at the dividend, and you have to remember, with dividend stocks, you are hoping to get paid in two ways. Number one is appreciation of the underlying asset, and number two is those regular dividend payments. So what is the use of a high dividend yield if the underlying asset is stagnant or if it's even depreciating? So you want to look at both of these things. You want to see a good history of appreciation of the underlying asset. And what I mean by that is a rising stock price. And you also want to see consistent dividends and a high dividend yield compared to the average of that sector or industry. Okay, so now we're going to go over the Dow Jones Industrial Average and what stocks are currently on the Dow Jones Industrial Average. So if you're looking for some blue chip stocks, these might be some great ones to put on your list. And this is as of August of 2017. Periodically, the Dow Jones Industrial Average does change, so I would recommend looking at a more current version of this if you're watching this course down the road. But first of all, we have ExxonMobil Corporation, that is obviously the gas company. We have the Boeing Company, we have DuPont, Walmart Stores, a retail giant. We have Johnson & Johnson, Microsoft Corporation, United Technologies, Chevron Corporation, we have Visa, we have Intel Corporation, and then next on the list here we have Apple. They're a Dow Jones Industrial Average stock. We have Procter & Gamble, the household giant. We have JP Morgan Chase. We have the Walt Disney Company. And then we have the Coca-Cola Company, one of the stocks that people have been investing in for years. We have Goldman Sachs, we have General Electric, we have McDonald's Corporation, we have the Travelers Companies, we have Pfizer, and then the final 10 on the list are the 3M Company. We have International Business Machines, or IBM. We have Merck & Co. We have the American Express Company. We have Verizon Communications. We have Caterpillar, the construction company. We have United Health. We have the Home Depot, which is a surprising one to many. We have Cisco Systems, and a newer addition to the list is Nike. So I'm hoping now you have a good idea of what blue chip stocks are, why people invest in them, that's largely for income, and where you would find a list of blue chip stocks. And we're going to talk about portfolio diversification later on, but do remember, if you were to invest in a portfolio of blue chip stocks, you would want to be investing in all kinds of different stocks. So you wouldn't want to be investing solely in retail stocks or solely in oil stocks. The more diversified your portfolio is, the better off you are. So ideally, you would pick stocks of all different sectors and have a broad diversification of blue chip stocks. And again, if you're not somebody who wants to worry about picking individual stocks, your best bet is to hold index funds. But now we're going to shift gears a little bit and talk about growth stocks. So growth stocks are the stocks of companies that are increasing in capital value, and company earnings are expected to grow at a faster rate than the market or industry average. Now, these companies are more recently formed and they are not time tested like the blue chip companies. So growth stocks are significantly more volatile than blue chip stocks, and largely this is due to the type of people that invest in these companies. Like I said, a lot of people that invest in growth stocks are short-term or mid-term investors, and they do not hesitate to bail out on a stock. So you're going to see a lot more volatility. These are significantly less durable investments, but a lot of the times they have a lot more upside potential in terms of that asset appreciation. Now, in terms of the price to earnings ratio, which we talked about earlier on, the stock is typically significantly more expensive than blue chip stocks due to the anticipated growth. And what happens is, and I believe I touch on this later on here, so if I do repeat myself, I apologize. What happens is, as we get into a bull market, especially an overextended bull market, more and more of that anticipated growth is factored into the stock price, and you're going to see that PE ratio climb higher and higher. So you're going to see PE ratios significantly higher in growth stocks than you will see them in blue chip stocks. So many who invest in growth stocks are not doing so long term, and as a result, many investors flee when the company falls on hard times, and this largely contributes to that volatility. As newer companies, they do not have a well-established track record in some cases, and the share price of growth stocks can go up or down at a moment's notice, making these potentially volatile investments, especially growth stocks in the tech sectors, in the biotech sectors. There are sectors that historically have much higher volatility. Now, volatility is nothing to be afraid of, but it is something that many beginners are not comfortable with. So me, as a seasoned investor, I have seen some volatility. I have held AMD and I have seen a 25% overnight correction, and it didn't even affect me. I just said, okay, well, the stock is in a correction, I'm going to hold on to it. I didn't sell, I didn't freak out. In fact, that was a time when I actually told my mom, buy some more shares of AMD. And I believe that is a time when AMD fell to just about $9 a share. It was after they released quarter one earnings, and they were somewhere between $9 and $10 a share. And I was down like over 25% on my investment, but I didn't worry about it. And I told my mom to make a sizable investment in AMD, and this was a great swing trade. She ended up trading later on when AMD was at $12 or $13 a share, somewhere around there. I ended up selling those shares, and she had a nice return just by following the principles of Warren Buffett and being greedy when others are fearful and buying at a time of pessimism. We're going to talk about this later during our talk on investing strategies, but if you were a beginner, I want you to ask yourself, how would you feel if, let's say, you had $10,000 invested in the stock market, okay? And I wouldn't recommend having $10,000 invested in any one stock, but let's say you did. Let's say you had $10,000 in AMD, and you woke up one day and you found that you were down $2,500 or 25%. How would you react? And we're going to talk about the psychology of the stock market later on, and I'm hoping that's going to help you with a lot of the fears you have, but I just want you guys to think about how would you react to that situation? How would you feel if you were down 25% on your investment? And if you're someone with thick skin and you're not afraid of that, then growth stocks would be a great option for you. But if you would get nervous, if it would stress you out and cause you to be anxious and kind of worried about your investments and affect other areas of your life, then don't bother. Don't bother with the growth stocks. Stick to the more durable blue chip investments. And if you want very low risk, go for the index funds. So growth stocks typically do not pay dividends, as the company is primarily focused on reinvesting earnings back into operations. So they are focused on growth. Now, growth investors are investing solely for appreciation, as there are no regular cash dividend payments in most cases. So growth stock companies are typically on the cutting edge of innovation or the leader in new or emerging industries. So at some point, like I said, guys, growth stock investors should expect to see a 20% or greater correction due to the volatility associated with growth stocks. So for me, this is when I saw a 25% drop in one day on AMD stock. And if you're not comfortable with this, then don't invest in growth stocks, or make sure they are a small portion of your portfolio. Now, the big question people have is, which is better? Should I invest in growth stocks or blue chip stocks? And the answer is neither is better, because it depends on the market. If you look at things historically, there are times when growth stocks have outperformed blue chip stocks or income stocks, and then the blue chip stocks have also outperformed the growth stocks at certain points. So it really has to do with how fast these growth stocks are appreciating, and you have to remember, when you look at dividend stocks, you have to factor in the dividends as well as the appreciation of the share price as well. So that is why it is really best for somebody to have a mix of both of these stocks in their portfolio, because at certain times each of these outperform each other. So there's no real good answer as to whether or not you should invest in growth stocks or blue chip stocks, because at certain times both are better. So that's just the answer to that question that many people ask me. While it is difficult to determine what is and isn't a blue chip stock, it is even more difficult to characterize a growth stock, and there's a reason for this. So when you look for a blue chip stock, you're looking for a stock that pays dividends, you're looking for a stock that pays consistent and rising dividends, and you're looking for a company with a good track record of meeting expectations when it comes to earnings, and just a company that is very durable and has a long track record of success. When it comes to a growth stock, there aren't too many telltale indicators, but I want to give you the most common ones. Many investors focus on the growth rate of the company, and they look for a projected 5-year growth that exceeds the 5-year historical growth. And maybe this sounds confusing, but all this means is they want to see a company that is growing faster today than they were over the last 5 years. They want to see growth increasing. They want to see faster growing companies. Another factor to consider is return on equity, and this is used to determine how well a company uses investments to generate earnings growth. We're going to get into this more when we talk about fundamental stock analysis and a lot of the things you can look for in these metrics, but just understand that investors want to see investments resulting in growth and growth of earnings. Because if companies are not able to use investments and generate substantial earnings growth, they're not using those investments wisely. Another thing you can look for is earnings per share can be a good indicator, because you want to see increasing sales resulting in increasing earnings for this company. So these are the things that many people look for. They look for growing earnings per share. They want to look for earnings per share that exceed the earnings per share of other companies within that industry as far as the growth of their earnings. They want to look for things like the return on equity. They want to see how well they are using the money that they are getting from investments. And they want to look at a growth rate and see if the future growth rate and the current growth rate exceed the historical 5-year growth rate. These are all good indicators that you are looking at a growth stock. And you will also be seeing these companies pretty consistently beating earnings expectations by Wall Street analysts. So you want to see consistent earnings surprises by growth stocks. One good example of this right now is NVIDIA. They are a tech company, and they have been blowing earnings expectations out of the water lately. So pretty much every single expectation analysts have made, they have beat those expectations, and that is a good indicator that you are looking at a growth stock. However, I did talk about how oftentimes in an overextended bull market, a lot of the anticipated growth is factored into the stock price. And I believe that's what happened with NVIDIA, because recently they did beat expectations, but the stock price fell significantly. And at that point, that is because the stock is priced for perfection, and really nothing would satisfy investors at that point because they have unrealistic expectations for that company. Anyways, here are a list of a couple of growth stocks, and again, this really comes down to what you see is a growth stock and what you are looking for yourself. And you may argue with me and say, no, I think Facebook and Google are now blue chip stocks in my opinion, and maybe more so with Google because they have been around a little bit longer. Facebook had a more recent IPO, but it all depends on what you consider to be a blue chip stock, and I hope you guys understand why this is kind of a gray area. But here are 10 stocks that I consider to be growth stocks, and I'm not saying these are good investments by any means. I'm just telling you these are examples of growing companies. So number 1 on the list we have Facebook. Number 2 we have Cirrus Logic. Number 3 we have Zillow. We have Google. We have GoPro. We have 6 Advanced Micro Devices, one of my biggest investments. Number 7 we have Fitbit. Number 8 we have Qualcomm. Number 9 we have Chipotle, and number 10 is Under Armour. So this is just a list of 10 companies that I consider to be growth stocks. Okay, now we're going to get into the good stuff, and by that I mean the absolute garbage. We're going to talk about speculative and penny stocks. Now, these are the stocks that have no business being in your portfolio, in my opinion. Now, this is the beauty of investing, guys. You can do whatever you want. You can go out there and invest in all of these stocks. I'm just telling you guys, this is what I recommend based on my own experience and based on what I've seen other people do in the past. So, speculative investments are a form of gambling. And while I do not discourage speculation, I think this should be done in a separate trading account. And rather than explaining this to you guys myself, I'm going to pull a small section from The Intelligent Investor by Benjamin Graham. And this is from chapter 1 of that book. And trust me guys, there is a reason this is the first chapter of this book. This was not done by mistake. There is a reason this is the first lesson covered in that book. And I want to just summarize the most important lessons of that book for you. And if you guys are looking to expand your knowledge about investing, this is the very next thing I would get my hands on, is a copy of The Intelligent Investor by Benjamin Graham, specifically the revised edition, because it has a lot of really good current examples. So let's go ahead and define an investment. So an investment is made after thorough analysis, promising safety of principal and an adequate return. I just want to read this again so I can solidify this, guys, in your head. This is what an investment is. An investment is something that is made after thorough analysis, promising safety of principal and an adequate return. Notice we're not saying an unrealistic return, and notice that safety of principal is the number one priority. Now, a speculation, on the other hand, is made when no analysis whatsoever has taken place, or the desire for an unrealistic return overshadows the safety of principal. So with a speculation, the number one priority is an unrealistic return, and safety of principal is put on the back burner. Unfortunately, many investors are actually speculators, and Wall Street really blurs the lines between these two. You won't really see Wall Street talking about speculation versus investing, and unfortunately many investors are actually speculators because they are not promising the safety of principal. They are looking for unrealistic returns, and they are more concerned with that than they are protecting their money, which is a mistake that many beginners make. So like I just said there, guys, speculating when you think you are investing is a common mistake beginners make. I don't discourage you guys from speculating. I think that it can be a very good learning experience. I'm going to tell you guys in a second, based on what Benjamin Graham recommends, what you should do if you want to speculate. But I never discourage people from learning, really. I mean, if you want to learn from my mistakes and, follow what I recommend from a couple of years of experience and years of seeing what other people have done and studying basically the success path of others when it comes to investing, I recommend that. But if you want to go through the process yourself, you're going to learn a lot by trying different things. But like I said, a lot of the learning experiences you're going to come across in the stock market are going to cost you money. And some of the greatest lessons I've learned have been from losing money. And one of my favorite sayings is there is no such thing as a free lesson. So you either pay for it in college, or you pay for it in a course, like you paid for this course, or you pay for it by losing money and going, wow, that sucks, I don't want to do that again. So really, guys, that's up to you. I just want to give you guys my opinion, and you guys can decide what you want to do. So if you have the desire to make speculative bets, do this in a separate account as to not confuse this with investing. So you should have a speculating account and an investing account. And if you do insist on speculating, here's how I would recommend doing this. And this comes right out of The Intelligent Investor, so this isn't by any means my own strategy. This is what Benjamin Graham has recommended people do. Allocate a small amount of your money, no more than 5% of your total portfolio. So if you had $100,000, this would be $5,000. And this is what you would allocate to the speculative trading account. And then what you're going to do is you're going to reinvest profits from speculation and never add money to this account. Wait a second. This is where people are going to stop me. They're going to say, why wouldn't I add to this account? Let's say over time I'm adding money to my investing account. Why wouldn't I add 5% of that money to my speculating account? Well, here's the thing. If speculation is going well for you, you're going to reinvest your profits. But if it's not working for you and you're finding you're running out of money, why would you want to feed more money into that? Why would you want to funnel more money into a losing strategy? So that is why I recommend with speculation, only reinvest money that you have invested already. Do not add more money to this. So maybe you have $20,000 lying around and you want to take 5% of that and you want to speculate with it and you want to invest with the other 95%. Any money you add to your investing account or to your trading accounts after that, in my opinion, that should solely go into your investing account, because if you're making good speculations, you're going to be making profits and you should reinvest those profits. But if speculation proves to be unsuccessful and an unsuccessful strategy, why funnel more money into it? And this is one of my favorite quotes out of The Intelligent Investor, and I hope this really hits home with you. Investors make money for themselves while speculators make money for brokers, because types of speculations are penny stocks and day trading, and think about the flurry of activity that goes on with those types of investing. And anytime you are active, Wall Street is winning. Anytime you're active, you're paying commission to brokers. So maybe you're starting to understand why Wall Street encourages activity. That's because Wall Street brokers make money when you're active. So bulls make money from rising stock prices, bears make money from falling stock prices, and Wall Street makes money from the herd. Wall Street makes money from the people that generate a flurry of trading activity, the people that follow the market, the people that make unintelligent speculations, and that's just the cold hard truth. And really it comes down to whether you're trying to fatten your own pockets or fatten the pockets of Wall Street brokers. And I'm hoping you guys really are starting to understand why most people lose money in the stock market. It's due to unintelligent speculation. Again, guys, I would pick up a copy of The Intelligent Investor and start going through that book as well. You're going to learn so much from that book, and that is a book that taught me a lot of what I know today about value investing. So let's identify what speculative or penny stocks are. As we know, we've talked about how they live on the over-the-counter bulletin board or the pink sheets. They live on these over-the-counter stock exchanges. You are typically not going to find them on major stock exchanges. So these are the stocks of companies that lack fundamental reasoning. In fact, these companies trade off major exchanges as they do not meet the basic requirements to be listed. And guys, if you're going to invest money in a company, you want to make sure they're meeting these basic listing requirements. And remember, think back to what we said earlier. If you're buying stocks on the pink sheets, those companies are not even required to file with the Securities and Exchange Commission. So there's really no regulation or overseeing of these companies, and there's a lot of fishy business going on, and that's something I would not want my money riding on, and that's why this is really unintelligent speculation at the end of the day. So as we said in Module 1, these stocks are high risk, volatile, and heavily manipulated. So even if you do invest in a company and you're able to find some sound, credible information on them, who's to say that stock price is not going to be manipulated due to that poor liquidity associated with these stocks on the over-the-counter exchanges? And even so, guys, it is very difficult to find credible information on penny stocks because, as we said, many of these companies are not required to file with regulatory agencies. So your guess is as good as mine as to how you're going to determine whether or not the information you're finding on these companies is credible information or not. Because these companies do not have to meet regulatory and filing standards if they are unlisted, namely the ones on the pink sheets. So who should invest in penny stocks? And I'm not even going to call it investing. Who should speculate with penny stocks? Penny stocks are suitable for those with a high tolerance for risk, a very high tolerance for risk, and those who understand that they may lose everything invested in them. Typically speaking, if you're going to invest in listed stocks on a major exchange, the risk of that company going bankrupt is relatively low unless we see some crazy things going on in the market or really some fishy business going on overall. Obviously, you know, we saw Lehman Brothers go bankrupt during the housing market crash, but that was due to a lot of irregularities going on in the market and a lot of things going on behind the scenes that should not have been going on. Typically speaking, you're not going to see these blue chip giants go bankrupt, but it has happened in the past, so don't think that there is no risk for them going bankrupt. But if you compare the risk of bankruptcy of a blue chip stock to a penny stock, there is a huge risk of a penny stock company going bankrupt. So in the next module, we're going to talk about investing strategies, and we are going to talk about day trading just because I want you guys to understand this so you understand how day traders make money. Do I recommend this? Absolutely not. But I do want you guys to understand all these different strategies out there so you have an understanding of how people make money or how people attempt to make money in the stock market. Unlike listed stocks with adequate liquidity, the chart patterns of penny stocks are typically erratic and very random. And these are not investments, guys. These are speculations. And as an investor, I would say you guys should stay away from these stocks. And if you want to do some speculation, maybe allocate 5% of your trading account and put it into a separate account and try speculating. And if it doesn't work, then say, okay, I'll cross that off my list and I will find a new strategy. Okay, so I just want to give you guys an example of the massive loss you can see with penny stocks. And this is a wonderful company called X-Rail Entertainment. I have no idea what this company does, and this is one that was a perfect example. This was back from August 18th, and in one day, this was a 59.44% loss. And if you look at this drop rate here, the stock went from $3.66 a share on Friday, June 2nd, to 40 cents a share by Monday, June 12th, before we even saw this loss and where they fell to 10 cents a share. So just in that course of 10 days, that stock fell 90%. So imagine if you had $10,000 invested in X-Rail Entertainment on June 2nd, 10 days later, you'd have $1,000. You would have lost 90% of that investment. That is terrible. That is not anything you want to see as an investor. And this is the danger you see with penny stocks. This is the kind of crazy price swings you see. Now, do we know what was going on with the stock? Not really. Do we know if this was a pump and dump scheme? Who knows? Who knows? With penny stocks, there's really no way to tell. There's not a lot of credible information on them. And this is what you're going to see very commonly with penny stocks, is these very drastic price swings. And as an investor, you would never want to have this kind of downside risk associated with an investment. Okay, so now we're going to move on and talk about bonds. So now that we have a good idea of what types of stocks are out there as far as growth stocks, blue chip stocks, and the penny stocks, now we're going to move into bonds. So a bond is a debt security or an obligation to pay back a debt that is issued. We've already kind of covered the difference between stocks and bonds in Module 1. The individuals who buy the bonds are collectively the lender for this line of credit. And then there are three types of bonds out there. We have corporate bonds, government bonds or treasury bonds, and then municipal bonds. So when companies issue bonds to expand operations, these are known as corporate bonds. Governments issue bonds to support government spending, and these are known as treasury bonds. And then municipalities issue bonds to support local government spending, and these are known as municipal bonds. And we're going to talk later about investments that are tax-free. And one of the best tax-free investments is municipal bonds. So when a company needs to raise capital, they have a couple of different options. The first logical option is to go to a bank and ask for a loan. However, when a company needs more than a bank can provide through a loan, they may issue bonds instead. And this allows numerous individual investors to lend the capital needed, and it does not put the burden on one single institution. So when a company needs more money than a bank can provide, this is often when they start to issue a corporate bond. Now, bonds can change hands on the secondary market after the bond is issued, and what I recommend looking at is the bond funds that trade through an ETF or an exchange-traded fund, which we're going to talk about in a little bit here. But I think that bonds are a very important part of any well-rounded portfolio. And as we said before, we were talking about how Benjamin Graham, his whole strategy is about having more money in bonds and less money in stocks during a bull market, and less money in bonds and more money in stocks during a bear market. So the bond issuer pays back the principal as well as the interest to the lender, and these payments are made on a predetermined schedule, and the rate is determined by the credit rating of the debt and the term of the loan. So longer term bonds are higher risk, and as a result they command a higher interest rate from the market. Now, low credit quality bonds are known as junk bonds, and these are higher risk of default, and as a result they have a higher potential yield. So unfortunately, many people are attracted to junk bonds due to the high interest rates, but understand that these bonds are from borrowers with lower credit ratings, and as a result there is a higher risk of default, so you're getting into a high risk territory. So unlike stocks with a variable income, because the appreciation of your stock changes on a month-to-month basis, bonds are a fixed income investment. So a bond has a fixed interest rate that does not change, and the lender receives that amount by bond maturity. Now, most corporate bonds pay interest twice a year to bondholders. So unlike dividends that are quarterly, a corporate bond would pay you twice a year, not 4 times a year. So as discussed in Module 1, bonds are a form of debt while stocks are a form of equity. So remember that if you are a bondholder, you are not an owner of that company. You are simply somebody that is loaning them money, and they are going to pay you back plus some rate of interest based on their credit worthiness. And as we said, a well-diversified portfolio has a blend of stocks and bonds. So when it comes to bonds, they are broken down into 2 categories. We have investment-grade bonds, and then we have junk bonds. And as far as investing goes, the only bonds you want to put your hands on are investment-grade bonds. And in order to determine this, you need to look at the bond rating. So now we're going to talk about the rating of a bond. So a rating agency assigns a risk of default to municipal and corporate bonds. But as we said earlier, there's government bonds as well. Well, here's the thing. Treasury bonds are exempt from rating as these are considered to be of the highest quality and the lowest risk of default. So the highest quality bonds you can own are treasury bonds or government bonds, and then municipal and corporate bonds are assigned a rating. Now defaulting, so when we talked about the risk of default, now defaulting is a failure to fulfill an obligation, and at that point the debt becomes bad debt. So the two rating agencies that rate the creditworthiness of a borrower are Moody's and Standard & Poor's. Now I'm going to show you what that rating looks like. It's a little bit confusing at first, so I know you might be a little overwhelmed by this, but this is Moody's ratings, okay? I'm not going to read this to you, I just want you guys to understand what you're going to be looking for. And that red line there is the difference between investment grade bonds and junk bonds. So if you're looking at bonds that have been rated by Moody's, you want to invest in bonds with a credit rating of Baa3 or higher. These are going to be considered investment grade bonds, and the highest rated bond by Moody's is the AAA. Now here's what the Standard & Poor's rating looks like. It's slightly different, and again that red line indicates the line between investment grade bonds and junk bonds. So if you're investing in investment grade bonds, which you should be, you would want to be investing in bonds with a rating of BBB- or higher, and the highest possible bond rating on the Standard & Poor's is again a AAA. So a AAA rating for both Standard & Poor's and Moody's is considered to be the highest quality and the lowest risk, but do remember that above that you have the treasury bonds that are considered to be of the highest quality. So let's talk a little bit more about these investment grade bonds, because these are the bonds that I'm hoping are going to be part of your portfolio. This is a bond with a rating that corresponds with a relatively low risk of default, and investment grade bonds are the only bonds you should consider investing in. That's why they're called investment grade. They're worthy of investment. While riskier bonds command a higher interest rate that may seem attractive, these bonds are not investment quality. So before investing in a bond fund or a bond, I want you guys to analyze the credit rating of that bond or the fund itself. And you can do this very easily when you're looking at a bond fund. For example, if you go on the Vanguard website and look at some of their bond ETFs, you can click on them and it will give you a breakdown of the percentage of the bond that is what classification as far as the credit worthiness, as far as the credit rating. And whether or not it is done by Moody's or Standard & Poor's, you'll be able to tell by the sequence of the letters they are using, but you want to see bonds that are solely lying within the investment grade bond rating. So now we have junk bonds. Now junk bonds have a higher risk of default and a higher yield due to that risk. Now borrowers that do not have investment grade creditworthiness might be in good standing during a prosperous economy. So during a bull market, during a prosperous economy, a lot of the borrowers that fall under the category of junk bonds based on their creditworthiness, usually during a good economy they're going to be okay. But if economic conditions change, these borrowers are at a high risk of default. So some hold junk bonds in a bull market because they know that odds are they're going to be okay. But again, this comes down to the strategy of trying to time the market, which is really a losing strategy. It's impossible to do this with any sustainable accuracy. So, do I recommend doing this? Not necessarily. Long-term investors should avoid junk bonds as they should not be held long-term. The only bonds you want to hold long-term are the investment-grade bonds. And the best way to do this is through a broad exposure through an exchange-traded bond fund. Okay, so now we're on to one of the parts I've been really looking forward to. We are going to talk about mutual funds, and these are dogs when it comes to investing. So active money management is expensive. Anytime you guys hear the words active management when it comes to money, I want you to think of expensive in your head. Most retail investors cannot afford professional management of their money, so for a while, this was kind of a problem. But then the mutual funds came around, and what this does is this allows small investors to collectively pool their money and have it managed on their behalf. So before the ETF, or the exchange-traded fund, was born in the 1990s, this was the only option aside from investing in individual stocks or paying for professional management. Now I'm guessing as somebody who was watching this course, you're somebody who is interested in managing your own money and possibly picking your own stocks for long-term investments or whatever strategy you do decide on. But for those of us who are not interested in an active investing approach and we want something more passive, for a while the only option you had was these actively managed mutual funds. But now the ETFs have really changed the whole investing scene. In a mutual fund, securities like stocks and bonds are constantly being bought and sold, resulting in a flurry of transaction costs and commission costs and a tax drag. So later on in this course, we're going to talk about investing taxes, and you have long-term capital gains tax and short-term capital gains tax. And oftentimes when these mutual funds are reallocating, a lot of those capital gains fall under the higher rate or that short-term capital gains tax. Another thing to realize about mutual funds is that a certain amount of the fund is always held in cash for redemptions, and this is known as the cash drag of a mutual fund. They always know that there's going to be a certain percentage of people that are going to redeem on any given day or any given period of time. So in order to have liquidity and the ability to pay those people off, they need to have a certain portion of the portfolio sitting there in cash, and sometimes they will leave some money in cash to wait for an investing opportunity. Now, as somebody who is investing, you may not be interested in that because that is known as a cash drag, and that is money that could be working for you, but it's not because they are leaving it there in cash. So the expenses for managing the fund as well as researching and analyzing stocks are passed along through the expense ratio. And most people should hold exchange-traded funds instead of mutual funds. Now, I was going to go into a whole section on this and talk all about this, but I really didn't feel I could do this justice just because so many people before me have addressed this topic. If you guys really want to learn about the true cost of active money management, I want to point you in the direction of Money Master the Game by Tony Robbins, or if you want a more condensed version of that book, he recently released the book called Unshakable, and those really pointed out to you what the true cost of active money management is. But I am going to go over a few statistics for you, but just understand that the mutual funds came around as a solution to the fact that most small investors could not afford active money management. They can't pay a financial advisor to invest on their behalf. But when they collectively pooled their money, they could afford to have professional money management. However, now that the ETFs have hit the scene and people can have broad market exposure at a very low expense ratio, most mutual funds are not beating what these markets are paying. And this is why most investors, if not all investors, should be holding exchange-traded funds. I want to throw this statistic at you guys. So in a 10-year period ending in 2015, 82% of actively managed large-cap mutual funds failed to beat the return of the S&P 500. So mutual fund investors pay a premium for the active management of the fund. However, if 82% are not beating the market, what exactly are you paying for? What value are they adding by actively managing that fund? If you have a mutual fund, make sure the fund is consistently beating the return of the market. I want you guys to realize that in that 10-year period, you could have invested in a Vanguard 500 fund that tracked the S&P 500 for a very low expense ratio. I'm talking a fraction of what these mutual funds are charging you through an expense ratio, and you would be paying less in expenses, also beating the return of that mutual fund. So if you guys currently have a mutual fund, what I want you to do is I want you to benchmark it to the S&P 500. I want you to take the performance of that fund, compare it to the S&P 500, and remember to subtract the expense ratio from that return. So if you saw a 9% return from your mutual fund, but they're charging a 2% expense ratio, understand that's really a 7% return. So if after expenses your mutual fund is consistently beating the market return, then you have a good mutual fund. But most of them are not. In fact, 82% are not beating the market before you even factor in the fact that their expense ratio comes off of the return. The number is very low, guys. Very few mutual funds are beating the market return, and that is why most passive investors should hold index funds or exchange-traded funds. You should not be investing in mutual funds unless your mutual fund is consistently beating the S&P 500 and the overall return of the market. Other than that, you should just hold the broad market through an ETF. Okay, so now we're going to talk about my favorite investment vehicle, the exchange-traded fund. So mutual funds and ETFs are very similar, so we're kind of going to be going back and forth in this section here. Now, an ETF or an index fund is a fund that tracks a specific underlying market. So later on, we're going to talk about stock market indexes. I'm sure you're already familiar with the S&P 500, the Dow Jones Industrial Average, and you could find an ETF that tracks both of those. So the truth is, most investors are not able to consistently beat the market. And if we use the statistic from the last slide, we saw that 82% of professional money managers are not able to do this. So the big question people ask is this: if these professionals are not able to beat the market, how would you be able to beat the market? But you do have to understand that when you're managing a larger amount of money, you can't necessarily change things around as easily, and you do have things like cash drag that are going to slow down the fund as a whole. So I think if you are an active manager of your own money and you really do know what you're doing, and you really do study and focus on long-term investing and really understanding the value of what you're investing in, you could be somebody who beats the market. I mean, I've been able to beat the market on a pretty consistent basis here, so it's not impossible. But many people are not even interested in trying that, but they still want to invest, and that is when you should be investing in these exchange-traded funds. Rather than picking stocks and trying to beat the market, many decide to own a piece of the broad market, which is a great strategy. And rather than paying for active management with lackluster performance, and by lackluster I mean, as you can see, 82% failed to do their job, most should hold index funds over mutual funds. In fact, I believe everyone, unless you're in a mutual fund that consistently beats the S&P 500 at a rate that exceeds the expense ratio. So even if they're getting a 9% return, if they have a 3% expense ratio, they're probably not beating the average return or the annualized return of the S&P 500. So rather than paying for active money management when these active money managers are not able to provide the results you are expecting, just own the whole market. Rather than trying to beat the market yourself, many people want to just hold a broad market index. So an index is a tool used to measure the value of a portion of the total market, and we're going to talk about indexes later on. Index funds are designed to replicate the performance of the underlying index. So if there was an index fund tracking the S&P 500, the index fund would be allocated such that it replicated the performance of the S&P 500. Now, index funds give you broad market exposure with a lower expense ratio due to the passive management. So there's no active analysis, there's no active research that goes into an index fund because they're just replicating the performance of an underlying index. And as a result, the expense ratio is significantly cheaper. And even better, I recommend Vanguard index funds because they are some of the lowest fee index funds on the market. So if you're going to go with index funds, which I recommend you do, or these exchange traded funds, your best bet is to go through Vanguard, and they offer index funds you can invest in like a mutual fund through the Vanguard account, or exchange traded funds that trade on the secondary market like a stock. So the other benefit to exchange traded funds is that the only time the investments change is when the underlying index changes. So as a result, index funds have a lower turnover, resulting in less commission costs and tax drag, because most of this is going to fall under the long-term capital gains tax. So all of these things combined make index funds a great passive income strategy. And they're very simple. There's not a lot to them. It's very passive. You go ahead and buy index funds, and maybe you're going to follow the strategy of dollar cost averaging, which we're going to talk about later, where you're slowly adding to this over time, and maybe you have an ETF fund tracking the S&P 500 and an ETF fund of high-quality long-term government bonds, or whatever your bond allocation is. And over time, you're just going to continue to add to these things. The biggest difference between a mutual fund and an exchange-traded fund is how they are purchased. So mutual funds are purchased through the issuing investment company. So maybe it's Franklin Templeton, maybe it is Fidelity, but you're going to go through that website and you're going to open an account with them. And oftentimes they have a minimum balance to actually open an investing account. So ETFs are traded on the secondary market like a stock, which is beneficial to investors because if you already have a trading account, you don't have to set up a separate account in order to invest in an index fund. You can do it through exchange-traded funds. This is index funds traded like a stock. So most mutual funds, like we said, have a minimum balance to open an account, while an ETF can be purchased as individual shares. So you can get involved with an ETF for the price of a single share, whereas with a mutual fund or an index fund, you would have to pay the minimum balance. And I do know if you go on the Vanguard website, they call these a mutual index fund. So they do call them a mutual fund, but it's a very low expense mutual fund. Now, ETFs are significantly cheaper in terms of management fees and expenses. You guys can look at the average expense ratio of this or compare some of the Vanguard funds to the other funds out there. And this is represented in the expense ratio of the fund. Okay, so now we're going to have a little bit of fun here. I'm going to compare the performance as well as the expense ratio of one of the most expensive mutual funds I have ever found compared to a Vanguard index fund. So here we have the Oppenheimer Steel Path MLP, which is a Master Limited Partnership, Select 40. So this is basically a fund that invests in oil and gas limited partnerships. And as we can see, this mutual fund has an astronomical expense ratio of 5.66%. This is one of the highest expense ratios I have ever come across. So I want you guys to pay attention to this chart, okay? And tell me if you see any similarities when we look at the next chart. Because I'm guessing, as you can tell, they look very similar. Very similar performance from these two funds here. So here we have the Vanguard Energy Index Fund Admiral shares. So this is a pool of stocks of companies involved in energy products such as oil and gas. And look at that expense ratio, guys. The expense ratio for this Vanguard Index Fund is 0.1% compared to an expense ratio of 5.66% from the actively managed mutual fund. And as you can see, the performance over the last 5 years has been very, very similar. So this is just an example of how expensive mutual funds can really be. And this is why you can usually find an index fund that's going to give you the exposure that you're looking for. Both ETFs and mutual funds are pools of money allocated into a portfolio of investments. Both ETFs and mutual funds offer diversification through broad market exposure. The investor who buys either a mutual fund or an ETF has no input on what investments are included within the fund. So this again comes down to whether you're looking for a passive investing approach or an active investing approach. If you're looking for a passive approach, you would be somebody who invests in funds because you do not want to be worrying about asset allocation yourself. But if you want a more active approach, you might be somebody who invests in individual stocks themselves because you want to have a say in what you're investing in. Now, both ETFs and mutual funds are passive investing approaches, and there's no reason to say you couldn't have a mix of a passive and active investing approach where maybe you have half of your money in ETFs and you have half of your money in individual stocks. This might not be a bad strategy either if you want to have a mix of both worlds there. Okay, so now we're going to move on to retirement accounts, and we're going to talk more about the IRA when we talk about investing taxes and ways to invest tax-free. So if you're investing long-term for retirement, you should maximize your contributions to a tax-sheltered retirement plan first. Now, a self-directed retirement account allows you to decide what you are investing in. Most people have no idea that you can get a self-directed IRA where you yourself are choosing what you're investing in. An IRA is an individual retirement account, and these accounts can be opened with a financial institution like Vanguard. Again, I am by no way getting paid by Vanguard to say this. I just highly recommend Vanguard because they have some of the best products and the least expensive products in the industry. So anyone with earned income can contribute to an IRA. However, there are income caps. So if you make over a certain dollar amount, you may not be allowed to contribute to an IRA. So first we have the traditional IRA. A traditional IRA has a yearly tax-deductible contribution limit that changes over time. So in 2017, this was $5,500 or $6,500 if you are over 50. Now the money grows in an IRA tax-deferred, so you pay taxes when you draw the money at retirement age, which currently is 59 and a half years old. At this point, the withdrawals from this account are taxed as ordinary income, and if you withdraw too early from an IRA, you will be hit with a penalty. And traditional IRAs have income limitations and qualifications as well, so if you're somebody who falls under these limitations, I highly recommend investing in an IRA, but if you make over that amount, you may not be allowed to just because of the limitations and qualifications surrounding IRAs. And then we have a Roth IRA. This is my favorite type of retirement account. A Roth IRA does not provide a tax deduction. However, the money invested in a Roth IRA has already been taxed, so it grows tax-free. So because you pay taxes on the way in, you do not have to pay taxes on the way out as long as you wait until the retirement age to withdraw from that account. And once you withdraw from that account, you withdraw tax-free. So with a Roth IRA, especially a self-directed Roth IRA, you can allocate this fund however you want, pay taxes on the way in, and have tax-free income by the time you reach retirement age. So this is absolutely amazing, this product here. As with the traditional IRA, early distribution penalties will apply, and IRAs usually involve mutual funds. However, active investors can open a self-directed IRA. Again, You don't want to be invested in mutual funds because the returns are going to be eaten up by those expense ratios. So I highly recommend a self-directed IRA. And then we have the 401k plans. These are really the plans that replaced the pension. This is a company-sponsored retirement plan. So money is set aside from each paycheck and contributed to the retirement fund. And some employers offer a match up to a certain percentage. So if you are in a situation where you work a job and you're a full-time employee, and as part of your benefits you get a 401k, one of the most important things you need to do is maximize your contributions as far as what the company will match. So in my case, when I was employed, my company would match 50% of contributions up to 3%. So I made sure I was contributing over 6% to that account. So that way they would match that maximum contribution of 3%. If you don't do this, you're throwing away money. It's free money that the company is willing to give you, so you might as well maximize that contribution. Now, the downside to a 401k is that it is not self-directed, so be selective about what mutual fund your money is allocated into. So you do have to select from a pool of mutual funds, but you can decide and look at which mutual fund is going to be the cheapest. Luckily, my employer went through Vanguard, so I was able to find a very inexpensive mutual fund, but unfortunately, a lot of employers are going through investing houses that are very expensive and charge a very high expense ratio, and you can't be self-directed with a 401k, so unfortunately you are at the mercy of whatever investment house they go through. Now, contribution limits do apply to a 401k plan, and this is set at $18,000 per year, so that's a very high number. It is out of reach for many people, but maybe eventually you'll get to a point where you can maximize your contributions. That would be fantastic. Alright, so now we're going to be getting into a REIT, or a real estate investment trust. So earlier when I talked about dividend stocks, I talked about how a dividend stock is kind of like rental income because you have a rental property that's going to appreciate in value but also pay you while you own it. That's kind of similar to a dividend stock, and dividend stocks are very similar to a real estate investment trust. The only thing that is different is with a dividend stock, the underlying investment is a company, while with a real estate investment trust, the underlying investment is a pool of real estate. So a real estate investment trust is another popular investment vehicle, very similar to a dividend stock. A REIT trades like a stock but resembles a mutual fund because it is a pool of investments. A REIT is a pool of real estate investments that generate revenues through leasing, renting, and selling of properties. And what people like about REITs is that REITs generate hefty dividends, as 90% of the net income is required to be passed along to shareholders through dividend payments. So REITs are a very popular investment. Many dividend investors and income investors love real estate investment trusts. Now, due to the generous payout, many compare a REIT to a dividend or income stock, and REITs offer a diversified approach to real estate investing with high liquidity. So one of the biggest problems with real estate, as we talked about early on when we were talking about the liquidity of the assets you own, is that real estate has very low liquidity because it's difficult to sell a house. However, if you want to sell a REIT, especially one that trades on an exchange-traded fund, it would be as simple as selling a stock on the secondary market. So this brings a much higher level of liquidity to real estate ownership. Now, a REIT is a great addition to an income stock portfolio and provides diversification across different asset classes. So if you're somebody who's interested in being a long-term income or dividend investor, you might want to look at a REIT and consider investing in a real estate investment trust. And what's cool about a REIT as well is you can also invest in a REIT exchange-traded fund, and I believe Vanguard offers a few of these, which is actually a collective mutual fund of real estate investment trusts. So it's very, very broad diversification of all kinds of income generating real estate all over the world in some cases. So now we're going to get into a less desirable investment, and this is a very high risk investment. This is the inverse ETF. Now, a traditional ETF earns you a return when the underlying asset in the fund goes up in value. An inverse ETF, however, is designed to go up in value when the underlying asset goes down in value. So it is designed to do the exact opposite of the underlying index. Okay, so here we have an example of an inverse ETF. This is the ProShares short on the S&P 500. So it is doing the exact opposite of what the S&P 500 has done. So as you can see, this is down significantly over the last 5 years because it is performing the inverse of the S&P 500. This is what an inverse ETF looks like. And then we have a leveraged ETF. This is another very interesting ETF, but again, one that I would stay away from. A leveraged ETF is designed to multiply the price move of an underlying index by a given factor. This can be a multiple of 2 or more. So many people, including myself, refer to this as a leveraged form of gambling. It is very similar to trading on margin where you're trying to increase your leverage. This type of investing is high risk, and I do not recommend adding leverage to your investments or trading on margin, especially as a beginner. So I want to give you guys an example of a leveraged ETF right here. This is the ProShares Ultra Short of technology stocks. So this is a leveraged short ETF on technology stocks. So this is an inverse ETF that is 200% inverse of the Dow Jones Technology Index. And this is some absolutely terrible performance here. We're seeing this fund has gone from over $150 a share in 2013 down to $21 a share because it is a leveraged form of inverse investing. And obviously tech stocks have been fantastic performers over the last 5 years. So an inverse fund, especially a leveraged inverse fund against these stocks, is a very poor investment. But this is just an example of what a leveraged ETF might look like. So now we have the most boring investment vehicle out there, and this is the certificate of deposit. This is a timed deposit of cash through a bank or a credit union, and in exchange for tying up your cash for a set period of time, you receive a guaranteed rate of interest. And a CD is insured by the issuing bank, and it is completely risk-free because they are FDIC insured. And in this low-interest era we live in, the return offered through a CD is not one that interests the average investor because you are not going to outpace inflation with the interest rate generated from a certificate of deposit. The only time I would use a CD is, let's say you have money saved up for the down payment on a house, and you're not planning on buying a house for 2 years. You don't want to invest that money, so maybe put it into a 1-year CD or a 2-year CD if you can find one. That way you're earning some rate of interest that will likely outpace what a checking or savings account will give you. Now, very similar to a CD is a money market. Now, a money market fund is a collection of highly liquid and low-risk short-term investments. So while that sounds appealing, I want you guys to remember that low risk means low return. So a money market is designed as a place to park your cash between investments and earn a small rate of return. A money market is not designed to be a long-term investment. And a money market fund will likely beat the return of a traditional savings or checking account, but not by much. And you'll probably see a CD will have similar, if not slightly better, returns than a money market. So again, this is not somewhere to put your money long term, but if you were in between investments and you wanted to earn some rate of return, you could park your money in a money market account. And then we have royalty trusts. This is another type of investment and one that many people are not familiar with. But royalty trusts generate income from the production of natural resources like coal, oil, and natural gas. So companies will have holdings of land rich in natural resources and charge a royalty for exploration of those resources. And then the royalty fees are passed along to the investor through dividends, and royalty trusts are heavily impacted by the price of natural resources. So obviously, over the last couple of years, we've seen very weak oil prices. This would probably not be a good time to invest in royalty trusts. Personally, I have never invested in them, so I can't share any personal experience. If this is something that interests you, I would highly encourage you to do some research and find out more about them. But here we have an example of a royalty trust. This is the BP Prudhoe Bay Royalty Trust. As you can see, this royalty trust has a great dividend, but don't be dazzled by dividends because look back in 2013, just before then, this trust was at $100 a share or more, and now we're at $19.30 a share. So it's been heavily impacted by the price of oil, and as a result, we're seeing a dividend that is a little bit of a pseudo dividend there because it's only that high because the performance of the underlying asset has been very poor. Okay, so now we have options, and this is a very interesting type of investment. This is not something I do myself, but I do have friends of mine who know a lot about options. They've been studying specifically options for a very long time, and they have had very good luck with options. So options are a type of speculative bet on the price movement of an underlying investment, and options have a set expiration date. I'm going to explain to you guys the very basics of this for educational purposes. If you are interested in learning about options, this is not the course where you're going to learn everything you need to know about options. I've never traded options. I know a lot of people do, and I wouldn't recommend them for beginners. They are a type of speculative investment, but if you know what you're doing, especially in a bull market, options can be a way to see very good returns from the market. So if this is something you guys are interested in, I would recommend looking for books specifically on options or courses specifically on options. But I'm going to give you guys the basics here. So you have two types of options out there, a call option and a put option. So a call option is a bet that the asset will go up in value, and a put option is a bet that the asset will go down in value. So first we're going to talk about call options, and options are something that are very hard for a lot of people to understand. So I'm going to try to use a very simple example to explain to you what it might look like to use an option. So let's say that John is selling a house for $200,000 and Mary wants to buy this house in cash, but she's not going to have the cash for 2 months. So Mary gives John a $6,000 option premium to take the house off the market for those 2 months while she's able to come up with the cash. So the call option is to buy the house at a strike price of $200,000 before the expiration date 2 months from now. So Mary can buy the house anytime in the next 2 months at the strike price. Now, if she does not buy it and the option expires, John keeps the $6,000 premium. What this means is that if Mary decides to exercise the option and buy the house, she pays John the full $200,000, what he was asking for the house, on top of the $6,000 option premium. So no matter what happens with an option, you will never see that option premium come back. That is what you're paying to have the option to buy whatever it is that you are trying to buy. So let's look at two possible scenarios here with this call option. Scenario one is John's house goes up in value by $50,000 in those 2 months. And as a result, Mary exercises the option and makes a profit of $44,000. Let's say John's house goes down in value by $50,000 and Mary lets the option expire, thus losing the $6,000 option premium. But again, she didn't end up buying it and losing that $50,000 of the loss on the value of the home. So essentially with a call option, Mary is in control of a $200,000 asset for 2 months for $6,000. Now, the difference between this and stocks is that option premium, because that's going to be a variable rate. So if multiple people wanted the option to buy John's house, he would charge a higher option premium. So the option premium is relative to the demand for the option to buy John's house. So the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. Now, a call option is a contract between two parties to exchange a stock at a strike price by the expiration date. Now, the buyer has the right, but not the obligation, to buy the stock at the strike price. So let's say that stock appreciates in value, and he decides he wants to exercise his right to that option. He will buy it at the strike price. Now, the seller is obligated to sell the stock if the buyer exercises the option to buy no matter what. So the buyer has a right, but not an obligation. Meanwhile, the seller has an obligation. So now we're going to look at an example of a put option, and for this we're going to use car insurance as the example. So let's say John owns a car worth $25,000, and John is worried about his car being damaged. So he buys an insurance policy on the car at a strike price of $25,000. So Mary is willing to offer John this insurance policy at a $1,000 option premium with an expiration date of 1 year from now. So let's go through two scenarios here. Scenario one is John's car is not damaged in 1 year and Mary made $1,000 insuring this vehicle. Scenario two is John's car is damaged and needs $5,000 in repairs, and he exercises his put option and Mary pays for the repairs in full. Now, scenario three is where John's car gets stolen, and he also exercises his put option, and Mary gives him the full value, or $25,000, for his car. So Mary sold numerous put options that were never exercised. So even though she may have had to pay for John's full value of his car, even though he only paid her $1,000, she had multiple put options expire without execution, so she is still in the green. So obviously when people go out there and get insurance for their vehicles, everyone pays a different rate, and that is largely based on the record of that driver. So Mary is going to charge a different rate or option premium to people that she's going to insure based on the perceived level of risk. So the higher the perceived level of risk is, the higher the premium demanded by the market. So a put option is a contract between two parties to exchange a stock at a strike price by the expiration date. The buyer has the right, but not the obligation, to sell the stock at the strike price. Meanwhile, the seller is obligated to buy the stock if the buyer exercises the right. So the buyer has the right, but not the obligation, to sell the stock at the strike price. Meanwhile, the seller is obligated to buy the stock if the buyer exercises the option to sell. So in this case scenario, again, the buyer has the right but not the obligation to sell, but the seller is obligated to buy that stock if the buyer exercises the option, and this is a put option. So again, this is a very simple explanation, and that's pretty much all we're going to talk about as far as options. They're not something that I do myself. I don't invest in options, and as such, I don't have a lot of experience to bring to the table. So this is something you guys would need to find another resource to learn more about options. Okay, I know this has been a marathon, guys. This has been the longest module I've recorded yet, but we are on our last topic. We're going to talk about futures, which is the final investment vehicle I'm going to discuss. So a futures contract is an agreement to make or take a delivery of a commodity or financial instrument at a fixed date in the future. So while the transaction will take place at a later date, the price is determined today in the open market. So futures contracts actually started as a way to manage the price swings of agricultural production. So harvesting cycles created huge swings in prices. So what happened is farmers wanted a way to sell their agricultural product before it was produced. So they created futures contracts for the commodity of the agricultural product they were going to produce, whether it be corn or wheat, whatever it was. What would happen is all of a sudden all of these farmers would have a crop, and as a result it flooded the market, and that huge supply would just drastically impact the price. So they all collectively agreed it would make more sense to create contracts and have buyers ready to roll, and they would set a price in the present that would be fulfilled in the future. That contract would be fulfilled down the road. So that is where futures contracts were really born, was with the agricultural production and a way to help balance out prices. So futures contracts offer the producers and buyers of these agricultural goods or commodities a way to buy and sell on the spot and defer delivery. And this helped both of them in this situation because the producers of these products would know what they're going to get for them, and those who were buying them already knew what their price was. So if they were going to sell them to other people or use them in some kind of production process, they wouldn't have their numbers already. So this is a way to buy and sell on the spot and defer delivery. So farmers could sell crops before the harvest and deliver them at a later date at a predetermined price. And each futures contract represents a fixed quantity of a commodity. And the commodity is broken down by quality and grade into different categories. So all aspects of the futures market are standardized. That's one of the good things about a futures market. Futures contracts are traded on an exchange, and very few futures contracts result in the delivery of the commodity or a cash settlement. So speculators buy futures contracts and sell them to someone else before the delivery. So futures are a type of speculative investment, and you buy them when you believe the underlying commodity will increase in value. So if you expect oil prices to rise in the future, you might buy futures contracts on crude oil and eventually sell that to somebody else who is looking for delivery of crude oil. So futures are broken down into four main categories. We have the agricultural futures, which is where this all started. This could be grains, this could be livestock or tropical goods. We have industrial futures, which may be energy and metals. This could be crude oil, it could be copper, natural gas, or building materials. And then we have financial futures, which is betting on the future prices of currencies, interest rates, and indexes. And then you also have stock futures. So again, I have no experience with futures. It's another type of speculative investment. And I just wanted to explain it to you and expose it to you guys, mostly for educational purposes, so you guys are familiar with these and how they work.